Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Does your family ever get exasperated with you for stockpiling such things as paper towels, bottled water, or toilet tissue? Well, they certainly can't object to you stockpiling money. Silver, the only money recognized by the U.S. Constitution, and your first 10-ounce bar of pure silver can be had at spot price with no premium by going to sdbullion.com/rp. And when you buy it that way, you'll be supporting Reluctant Preppers as well by going to sdbullion.com/rp. Thanks. This is a quick update to thank you for building our number of patrons to 76 and growing on patreon.com/reluctantpreppers. Soon, when we reach 100 active patrons, we're going to start sending out a 1-ounce U.S. Silver Eagle each and every month to one active subscriber, so you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
But from the government's point of view, they are on the same team as the big banks because it's all one big organization there. You know, JP Morgan Chase, the Fed, and the Treasury Department are not separate entities. They're divisions within a bigger entity that is geared towards increasing its own wealth and power rather than serving customers or constituents or anything like that.
Welcome back, Reluctant Preppers. This is the first time we've done a video interview with this returning guest. John Rubino from thedollarcollapse.com is here with us. Today is Tuesday, September 4th, 2018. John, thanks for joining us again here on Reluctant Preppers.
Thanks for having me back, Donegan. Good to see you again.
And if you could remind our viewers of your latest books that you've been working on and collaborating on, so they can check you out more of your work if they want to.
Okay, the most recent book is a few years old now, called The Money Bubble, co-written with Gold Money's James Turk. But the thing about writing an investment book is that timing is everything. And that book turned out to be about 3 years too early. The things that it predicts are just now happening. So the book is actually finally correctly timely. Now's the time to read it.
Right.
That's available on Amazon and bookstores and pretty much wherever you go to buy an investment book. I'm working on another that's 6 months out, but it'll be basically about what to start researching now with the intention of investing in it at the bottom of the next cycle. So that will be about all the new technologies that are coming along that will revolutionize the world and will be incredibly cheap when the next bear market in equities really gets going. So I'll try to time that one a little better than the last one.
That's one of the problems of being a forward-thinking person is it sometimes you get your insights out there, and that doesn't reduce their veracity or their impact. But it certainly, if people are trying to make trading timing decisions off that's not the right way to interpret that insight.
That is the story of my life. I have been too early with everything. And, eventually right. So, there's vindication at the end of the process, but it's painful along the way. And this is another case of that, because I've been talking about precious metals for several years. And they're down again today. They're at about as low as they've been since I've been telling people to get into them. But I think the turn is coming. So we should definitely cover that today.
Yeah, let's get into that. I just want to make a little plug here for if people will go to our website, which is not the YouTube channel, but the website, ReluctantPreppers.com, and you scroll down, you'll find our merchandise section. There's a T-shirt we sell there that says on there, "I'd rather be 7 years early than 1 day too late." So don't forget that. Yeah. So but do talk to us about, because you recently wrote about gold and silver behaving like it's 2008, and people have been watching this for 2 years now. We've been in this cone formation or flag formation with reduced and reduced volatility down to where it was getting to be quarter of a point moves in the the silver price, for example, and now it's broken out to the downside and most vigorously again today. But you wrote recently about how it's behaving like it's 2008. Can you help us understand that and see it the way you saw it?
Sure. Well, 2008 is a year that lives in the minds of a lot of gold bugs because it was really kind of epical. The economy was booming in the mid 2000s because of extremely low interest rates and governments basically just encouraging risk taking at every level. And so we developed a bubble in the housing market, which was centered on subprime mortgages, a little sliver of the housing market, but still something that was just rocking back then. And finally, as subprime bubbles tend to do, this one burst, and people started defaulting on their mortgages, which led the government and all the talking heads to say, oh, don't worry about it. It's just a peripheral kind of thing. It's small, it's isolated. The economy's growing just fine, don't worry. But they should have worried because it spread to the rest of the housing market, which spread to the banking industry, which basically almost took down the entire global financial system. So in 2008, when this was really coming to a head, you might have expected gold and silver to go up as a safe haven. In other words, that's where people hide out when they're worried. But it got swept, precious metals got swept up or down in the general market crisis, and they just cratered. Gold lost like 20% of its value in just a couple of months. Silver did even worse, and the mining stocks related to gold and silver did even worse than that. So you saw the gold price go to a several-year low. The gold to silver ratio, in other words, how many ounces of silver it takes to buy an ounce of gold, go up above 80, which is usually the end of that run. That's almost always as high as it gets during the cycle. And then the system basically almost collapsed, but the government stepped in, bailed out everybody in sight, cut interest rates, and started liquefying the globe, and gold and silver just took off. So the gold bugs of a certain age remember getting crushed in 2008, but also remember that as a setup for 5 amazing years, a really great bull run for gold and silver. Today, we've got something similar going on. The emerging market countries have borrowed huge amounts of US dollars, thinking the dollar would keep going down versus their currency, and they would make a really nice carry trade by borrowing dollars and investing in their domestic bond market. Well, it didn't work. The dollar started going back up. Now you've got all these basically bankrupt emerging market countries. Venezuela is gone. They're in a full-on hyperinflation. Argentina is collapsing. India just saw its currency drop to an all-time low. Turkey is a huge mess, and the Spanish banks have lent 5% of Spanish GDP to Turkey, and Turkey's on the verge of default. It goes on and on. So that's reminiscent of the subprime mortgages in the sense that emerging markets are outside of the mainstream. They're not part of the core of the global financial system, but they have the potential to cause a pretty huge crisis. Right now, everybody's saying it's okay. It's, it's contained. We'll do what we have to do to fix this, blah, blah, blah. But that's what they said about subprime mortgages. And we had a near-death experience then. So if the emerging markets end up causing the same kind of trouble for the global financial system as the subprime mortgages did back in the 2000s, we're looking at another global financial crisis. Now, gold and silver are both behaving the way they behaved in 2008 right now. They're just tanking. They've been drifting down for a while, and they fell hard today. So if we're going to repeat that, the decade of the 90s or the 2000s, there's a good chance that we will see gold and silver bottom at some point in the not too distant future. The government will step in probably by taking back the whole, we're going to have 4 more increases in the Fed funds rate and we're done with QE, thing that they've got going right now, and reversing course by cutting interest rates and going back to QE in order to stop the emerging market crisis from metastasizing to the rest of the world. And then gold and silver will take off. So if this is indeed another 2008, it's painful right now, but it's also really exciting because we're creating the conditions in which the governments have to go back to their aggressive monetary experimentation, only with the numbers being a lot bigger. We've literally doubled the amount of debt in the world since 2008, which means that the crisis, when it hits, is potentially a lot more serious because there's, by definition, a lot more bad debt out there if we double the amount of debt in the world. China quintupled the amount of debt that it has, and a lot of its debt is at local government levels where they have special financing vehicles, and nobody knows what those guys are doing. Nobody knows how much money they've borrowed, what they've spent it on, and whether what they've spent it on is generating any kind of cash flow. So China could be this huge wild card out there, but they're not alone. We've got the emerging markets, obviously. We've got the U.S. being grossly leveraged right now. We took on way more debt than we had back in 2008, 2009. And we didn't really spend it very wisely. We're not any better off now than we were back then. Europe is an absolute mess. They've got populist governments taking power who either are absolutely opposed to the continuation of the euro system, in other words, the common currency,
right.
or like Italy, they're done with the whole austerity thing. And they want to ramp up government spending in order to pursue populist political goals, which comes at a time when they've already, objectively been spending way too much money for way too long and taking on way too much debt. So if they're going to ramp up spending from here, we've got the real conditions for accelerating inflation. Because remember, inflation is already at central bank targets of around 2% in most major countries.
And that's if you're using the official figures.
Yeah, that's right. That's what they're telling us.
Because that's how I met you was at the Liberty Mastermind Symposium in Dallas. We were talking about that, and your talk there was about shrinkflation and about the hidden tax of inflation and the hidden aspects of inflation.
Yes, yeah, how unsound money corrupts a society because it causes everyone to who can't raise prices to start doing other things, lowering the quality of their products, basically, without changing the prices, so that we feel like we're getting ripped off because what we used to think of as a good deal is no longer a good deal, even though maybe the price hasn't changed. So anyhow, yeah, we're heading into a time of that already, even with central banks tightening a little bit or being less loose. But if they shift gears and go back to being aggressively expansionist, then all bets are off. And you would think that gold and silver would respond the same way they did in 2009, 2010, 2011, when central banks were being really aggressive, only more so because the numbers are much bigger. The imbalance between the amount of paper wealth in the world and the amount of precious metals is much, much bigger than it was back then. It was already big back then, but now it's immense. If 1 or 2% of global investable capital started flowing into precious metals, it would send gold to $5,000 an ounce, and it would send silver up faster than that. Silver would go to numbers that seem bizarre to even talk about right now. $100 an ounce, $150 an ounce, very easily, just because there's so much paper out there and there's so little precious metals. So we're looking at a kind of Bitcoin scenario for precious metals if we replay this scenario again that happened in the 2000s. And I think there's a decent chance that that's happening because there really isn't any other way out for central banks right now. If the emerging markets, they can't get their act together in a world where the dollar is going up or even where it's stable at current levels. So they are in large part bankrupt unless something changes. So the Fed has a choice of staying the course and letting 5 or 6 countries who owe several $trillions in the aggregate go bankrupt, or trying to bail out those countries and the banks that lent them money. See, that's where we usually do our bailouts. We don't care what happens in the rest of the world, but we do care when our banks are on the hook for what's happening in the rest of the world.
Sad that we think of them as our banks. There's so much emphasis among this community of concerned people that so many of these banks are international in nature, and even the ones that make up our so-called Federal Reserve. But go ahead.
Yeah. Well, no, actually, you're right. They're not really our banks. We are their wage slaves.
That's right.
We belong
That's how I was
to
waiting
them,
for you to say
that. Yeah. But from the government's point of view, they are on the same team as the big banks because it's all one big organization there. JP Morgan Chase, the Fed, and the Treasury Department are not separate entities. They're divisions within a bigger entity that is geared towards increasing its own wealth and power rather than serving customers or constituents or anything like that. So from their point of view, it's their banks. If the Spanish banks start to collapse, and that threatens the EU, which threatens the euro common currency, which threatens the global financial system, they take it personally, and they will act in any way necessary to stop the bleeding once it starts. And it really has started. We're there now. So they don't really have much of a choice but to start the bailout process. And they'll do that with words to begin with. They'll do the Mario Draghi, whatever it takes kind of thing, and make announcements like that and hope that does it, hope it restores confidence. When it doesn't, because it won't, they'll take the next step of loan guarantees, which doesn't cost anything up front. You just say, okay, we'll guarantee the debts of Spanish banks or Italian banks or Portuguese banks, and hope that reassures the bond market, allows these banks to continue to access capital, and maybe something happens down the road that fixes them. At least it buys time in the meantime. And if that doesn't work, which it probably won't, then they go to lower interest rates and QE, where they're buying assets from the banks to liquefy the banks. They'll just buy the bond portfolio of Turkish bonds away from the Spanish banks and give the Spanish banks dollars or euros in return, and in effect recapitalizing them. But that means that taxpayers are now on the hook for these busted bonds from the emerging markets, which is basically how it worked in 2008, 2009. We took over the mortgage industry in the U.S. $5 trillion went onto the taxpayer balance sheet. And we guaranteed the global banks stability with another, what, was it $7 trillion? I forget which number goes to what bailout now, but it was something like that, which we were on the hook for again. So we'll do the same thing, except this time around the numbers are much bigger. So where something in the past was 5 trillion, next time it'll be 10 trillion. And if the aggregate bailout was 15 trillion back in the day, this time it'll be 30 or 40 trillion. So the question then becomes, can the currency markets maintain when this is going on? Can the value of the dollar and the euro be stable when we're taking on debts at the central government level, which is to say the taxpayer level, of this magnitude? And I have no idea, because I thought the last time around was the end. I didn't think we could do what we did between 2009 and 2015 or 2016. I just thought that was impossible because the numbers were too big. I think the same thing this time around. If we double the numbers, it seems too big. But because my track record of knowing what's too big isn't so good lately, I wouldn't want to put any specific predictions out there. But the one I would put out there is that money will flow into precious metals, just because it happened last time, and it has historically happened. Whenever a country starts screwing up its finances, gold and silver do just fine because people hide out there. They know that's the one safe place that will hold its value. So the same thing will happen this time around, I'm reasonably certain. And the size of the global paper markets are so immense compared to precious metals that it should have a very serious impact on their price. That, I'm willing to say, is something that's very probable. Everything else, anybody's guess. All bets are off when this really gets going.
Could you help us at least understand what, for me, is a pretty non-intuitive early chapter in that before you get the flight of capital into precious metals, there's this sort of this bashing capitulation that happens first, where it seems the flight is into fiat first, and that like, it was used as, and it doesn't seem obvious when we look at gold and silver as a safety play, a safe harbor, why, when there's all of a sudden a lot of shaking about emerging market economies and all their instability and that sort of thing, why gold and silver drop along with other things rather than immediately picking up on the benefit of that?
Well, there are three things at work, at least three things. One is that when the stock market tanks, there are margin calls out there all over the place. In other words, people have to come up with extra money to pay their stockbroker to avoid having their stock portfolio just be sold out from under them completely at horrendous losses. So they cash out things that aren't doing so badly. In other words, they'll take a silver bar to the local precious metal store, coin store, and get cash for it, and then use that cash to pay their bills or to shore up their stock brokerage account. Or they'll sell gold mining or silver mining stocks along with everything else, which also tends to have a negative impact on precious metals. So you get that, the baby being thrown out with the bathwater. Gold and silver aren't responsible for any of this, but they suffer for it just because there's a lack of liquidity out there. And they are among the few liquid things that are still available. Second thing is that a stock market crash is inherently deflationary. So people stop worrying about inflation for a minute and start worrying about deflation. And that leads them maybe to sell things that they think of as inflation hedges, which are precious metals. And third, governments tend to manipulate the price of gold and silver down during crises just because those things are competing forms of money. And if they go up, that's the same thing as saying the dollar is going down or the euro or the yen. And that makes governments look incompetent because the currencies that they're running only exist because we have faith in their ability to run them effectively. So they tend to intervene to push down the price of gold, which pulls down the price of silver during crises. But none of that lasts very long. In the initial rush of a crisis, yeah, you get gold and silver falling, but governments always respond to crises, or at least they have since the 1990s, with much easier money. And that easy money then ignites people's interest in forms of money that can't be inflated away. You know, if your government is actively inflating away your currency, then all of a sudden gold and silver, which are kind of unwieldy and maybe they seem a little primitive in the age of credit cards and PayPal and stuff like that.
Crypto, yeah.
Cryptos. All of a sudden, they start looking pretty good because of their solidity and their history. You know, you look at them and think, all right, I read somewhere that in the Roman Empire, an ounce of gold bought a pretty good quality man's toga and some sandals, you know, and today an ounce of gold buys a pretty good quality man's suit. So it's held its value through wars and revolutions and all kinds of regime change and everything you can think of that the human race can throw at the financial system. Gold and silver have held their value. They have maintained the purchasing power of their owners since the beginning of recorded history. So why won't they do it this time around? You know, you would have to posit an extremely big change in human psychology and financial technology to think that this time, out of the past 3,000 years of crises, but this one crisis is going to be the one where gold and silver don't hold their value. And most people conclude that, it'll work this time around again. And so they start buying gold and silver. Then everything's going down but gold and silver. So momentum players get into it. You know, guys who see something moving in the right direction and they just pile in, even if they don't understand it, they get in because they look at their charts and assume that they can extrapolate the trend out a little further, and they pile in. Mm-hmm. And so you get a second wave of buying, which takes the asset class in question up to bubble territory. And that's kind of what happened with gold and silver. You know, silver went to $50 an ounce from $4 or something like that a decade before. Gold went from $270, give or take, to $1,900. And the last few $100 of that run, in retrospect, was bubble territory. It was people just buying it because it was going up. And they didn't want to miss out. So you get that towards the end of the process. Which is basically what we're looking at here. Right now, gold and silver are the baby being thrown out with the bathwater. They'll bottom at a certain point and start moving when governments inevitably step in to stop the bleeding from the emerging market crisis or the student debt crisis or the spinning out of control of the Eurozone or the Middle East war. You know, there are so many things that will require increased liquidity going forward. And when the government starts supplying those things, people will start buying precious metals, and then we head in the other direction for a long, nice arc that will end with a parabolic move into bubble territory. So at that point, the people who have paid attention in the past, who are listening to this now and getting it, will be ready to sell their gold and silver to the people willing to pay 4 or 5 times what it was when they started buying, you know, and hopefully we make that decision at the time. That's going to be the big intellectual challenge. When to sell your junior mining stocks, you know, because they're going to be going up at Bitcoin-esque rates, and it'll feel like they're just going to go up forever, and people will be telling you they're going to go up forever. You have to be sensible enough to take some money off the table on the way, because nothing goes on forever. But that's a great problem to have. I mean, if what you own is going up dramatically and you're trying to decide when to sell, it's a problem, it's a challenge, but it's a great one to have. You know, it's the one we all want to have, and we will have that with precious metals if this is 2008 again. So we'll see.
You passed 2 topics in there we want to touch on again if you could. One was the gold to silver ratio. There was a cute crack that David Morgan made a couple times ago when we talked with him. He said when the gold to silver ratio gets out of whack, he either loads up his pickup truck with silver and drives to the coin shop and drives home with a glove compartment full of gold, or he loads up his glove compartment full of gold and drives to the coin shop and drives back with a pickup truck full of silver. So, given that we're at, if you could talk to us about which of those scenarios looks like we are at or near when we should jump in our pickup truck, on which of those should we load in there?
That's a nice arbitrage. You could have done that for the past few decades and literally made a lot of money doing it. You could literally physically do that. Because when it takes 80 or more ounces of silver to buy an ounce of gold, that's historically been a place where it started to make sense to buy the expensive one or buy the cheap one and sell the expensive one. In other words, buy silver and sell gold, or buy more silver than gold, depending on your accumulation strategy. And we're there now. Silver today went from about 78, the gold silver ratio went from 78 to about 84. I don't know where it is right this minute, but during the day it hit 84 or 85. That's a signal, yet another signal, that precious metals are nearing a bottom, because the gold silver ratio tends to peak when precious metals prices bottom. Because when precious metals are falling, people tend to be worried. And when they're worried about, say, deflation or some other crisis that affects precious metals, they tend to want gold rather than silver, because gold is the relatively safe precious metal. So if you see more buying of gold than buying of silver, that makes the gold-silver ratio go up, and it implies that people are scared. And when it reaches a peak in the 80s, that implies that people are extremely scared. And when people are really scared, that tends to be a turning point, because if everybody's terrified, there's nobody left to do that thing that's causing the trend to continue. And 80 to 85 is a signal that we're at that point based on history. If you just look at the chart, you'd say, oh, okay, 80, time to buy silver, and either sell gold or buy less gold. We're there now. So that's yet another signal that precious metals are in a capitulation, and that over the next few years they'll move in the other direction.
In that scenario, you just described sort of silver as the more leveraged play. Gold tends to be less speculative than silver in either direction. You also mentioned mining stocks, and particularly junior mining stocks. So we've had you and a couple other guests in the past talking that those are typically a leveraged, that they tend to move in multiples compared to the percentage changes in precious metals themselves. So when we're seeing precious metals being beaten down by market forces as they are now, what does that lead you to conclude about if people want to watch for an entry time to make a move on mining stocks?
The mining stocks have gotten whacked lately. They really fell today. And they had been falling for, the better part of a few years, really, although they've had some ups and downs in that time. But they're much lower now than they were 3 years ago. So I think, again, based on history, we're at a point where mining stocks are a buy, the best ones. Now, one crucial thing to remember about gold mining and silver mining stocks is that most of them don't succeed. So you only want to buy the highest quality examples of the category that you're looking at. And that's most true with the junior miners and the exploration companies, because these are little tiny companies, and in a lot of cases with $100 million market cap or less, just tiny little things. Most of those will cease to exist. As Rick Rule likes to say, all the profits from the junior mining sector comes from 10% of the companies. The rest cease to exist. So the ones that succeed are frequently 10 baggers. They go up 1,000% or more. They just take off because nobody knows about them now. And by the time people do know about them, they will have had huge runs, and then we'll get that same momentum player thing at the end where just because they're going up, people will start buying them. But you have to be able to separate the wheat from the chaff. You want to be able to avoid the 90% that are going to cease to exist and load up on the 10% that are going to go up 1,000% or more. So you need help with that, because no regular person has the expertise to do that kind of analytical work with junior miners. There are some good newsletters out there, though, that are very helpful. They're put out by people who spend their lives digging through this stuff, literally sometimes digging through things. And they aren't always right, but they tend to be able to be right more often than random chance, which gives you a better chance of finding a few 10-baggers. I rely on Jay Taylor's newsletter.
Mm-hmm.
For a lot
We've had Jay on the show a couple of times. Yep.
Yeah, Jay's been doing this forever, and he really knows his stuff. When Rick Rule does an interview, people frequently ask him for his favorite stocks. I listen to that, write them down, and often buy some of them. So there are sources of information out there that are helpful. You should never do this stuff alone. You should always find experts whose work you can emulate and benefit from.
In addition to Jay Taylor and Rick Rule, I know we've had David Morgan on. We've also had Craig Hemke on. Each of them also has a newsletter as well that studies and researches on mining stocks. Go ahead. Yeah,
and there's several more. There are mining company conferences out there where the newsletter people are sponsors of some of the companies that come to visit. So that's a good place. Go to one of those conferences. You'll meet a lot of people who are experts in the field, and that will give you a big leg up over the average investor in gold mining stocks. Now, as for the big ones, there's a lot of big high-quality names out there. The streaming companies are probably the best, safest bets.
When you say streaming, a lot of people these days think about it as electronic, but you're talking about cash streaming.
Yeah, they're also known as royalty companies. Basically, what they do is they'll go up to a copper miner and say, you know what, we'll buy the silver that you make as an afterthought in your copper mining for, we'll give you this much money up front, and we'll buy the silver for $5 an ounce as you make it. Okay, and it works out to silver for $7 or $8 an ounce over time, which is extremely cheap with very little risk. You're not running your own mines. You're just basically a finance company, but one that is investing in gold and silver streams from mines. So the biggest and best of those companies, like Royal Gold and Franco-Nevada and Wheaton Precious Metals, have a wide variety of royalty agreements. So they're really well diversified, and they're really profitable. Even in today's market, they make money. When things really get going, let gold and silver double or triple from here, and the cash flow from these streaming deals will just go through the roof. They will much, much more than double or triple. So those companies will get very rich very fast, and their stockholders will benefit with relatively little risk. So that's a good place to get into precious metals mining stocks without risking losing everything on bad management or whatever.
John, I think those are the topics that we had to cover with you today, and we're very grateful for you stopping in and updating us on the emerging market situation, how it's going to affect the U.S. dollar, the Fed being boxed into a corner, the gold-silver ratio, and leveraging of mining stocks as a way of addressing how to look at the precious metals industry. So if you want to give our viewers an idea of where they can reach you online and what resources they'll find there, that'd be great.
Sure. I run dollarcollapse.com, and it's a site that's updated pretty continuously to cover the stuff we just talked about. So stop in once or twice a day, and you'll be up to speed on the dark side of the financial markets out there.
Once again, John Rubino, thank you for joining us here on Reluctant Preppers.
Thanks, Dunnigan.